In this video, we are going to go over Introduction to Financial Management. To begin with, we'll talk about the basic areas of finance. For this course, corporate finance is pretty much as business finance. These two terms are interchangeable. So when you hear one or the other, they're talking about the same thing. This would be where finance covers the business aspects of finance within a corporation. So this is not necessarily Wall Street or things like that, like securities and trading. This is the finance within a company. For example, every company like Walmart or Target or grocery stores, they have a financial department where they handle the finances of the business, which is different to what happens in the stock market. Investments is another section in finance that is more like the stock market. Now, for future finance professionals, the ones that are going to stay in the finance world, keep in mind investments is typically divided in two areas, or can be divided in two areas. What we call the security side, like security analysis, stock trading, etc., that type of stuff, bonds. And the other side is what you can call capital budgeting, which is more in tune with the corporate finance side. That is more about planning the long-term investments of the company. Like, do you build a factory? Do you start a new product? Things like that. However, what they have in common and why they're under investments is because about you put some capital up front with intent to generate returns in the future, whether it is through securities like stocks, or you invest in a new machine in your company, a new factory or an expansion with the expectation of getting some returns on that money in the future. Financial institutions is just what it sounds like to banks, insurance companies, broker firms, investment dealers, things like that. Financial institutions, it's pretty much any company that falls under the financial sector. Organization that falls under the financial sector. International finance, self-explanatory, the added elements that come in play when you're dealing across nations with different currencies, different interest rates, different tax laws, etc. Now, why study finance? Well, finance, as mentioned, it's the science of money. It's one way you can look at it. And well, money touches everything in life pretty much, especially in business. So from the marketing angle, there's budgets, market research, marketing financial products, pricing strategies, etc. Accounting, you already took, or you should have taken accounting class already. There's a lot of overlap, mainly on the financial statements. Management, from that angle, strategic thinking, performance, profitability. The list is very long when it comes to the management side, because at the end of the day, business intent is to make a profit. And the word profit and finance go along together. Personal finance, just what it sounds like, your retirement planning, college planning, your monthly spending, your budgeting, all those things that you will have, I guess, under home economics. Now, financial manager. So what does a financial manager do or try to address? So a couple of questions that they try to address are how to do cash management, credit management, capital expenditures, financial planning, and that typically falls under the treasury, or what they will call the treasurer as a position. Then you have the controller, and the questions they try to answer is taxes, the cost structure of the company, financial accounting, as mentioned, data processing. Data processing can be a wide variety of things, like all the way from inventory to just about anything that can be data can be collected within a company. And those two, the treasurer and the controller, fall under the CFO, which is the chief financial officer, which at that point oversees all of those things and makes decisions. Your typical corporate organization chart. Now, this is the simplest form. Not all companies follow this order. There is always going to be a board and a CEO and that kind of structure. Now, the titles and the names, especially now in the modern day where they're getting more creative with the titles, they may serve the same functions, they just might have a different name. But this is the standard stuff. You start with the board of directors on top. Then you got the CEO, which typically will be the chairman of the board, especially in the situations where the CEO founded the company at the time. So it's not necessary that the chairman of the board and the CEO are the same person. And there are good reasons where that they shouldn't be the same person, but that's governance. That's for a different class. And then typically under the CEO, you're going to have the president and the COO, the chief operating officer. And then you may have a series of vice presidents of marketing, vice president of production. And here it says vice president of finance, CFO. That is rare. The CFO is typically next to the COO, and president and vice president, those titles go in different. And part of the reason is what's typically considered the second most powerful position in the company after the CEO is the CFO. And the reason is because that's where the money is controlled and managed. Well, whoever controls the wallet, like you say, has the power. So that one specifically there, vice president of finance, CFO, being in that position, that is less likely to see that. And as we mentioned before, under the CFO, you got the treasurer, the controller, and then under the treasurer, as we mentioned, there's cash managers, credit managers, capital expenditures, etc. And same thing on the controller side, the managers of those items we spoke in the previous slide. Financial management decisions, which is the point of a financial manager to make decisions, include but are not limited to capital budgeting, as we mentioned before. What long-term investments or projects should the business take on? So as I mentioned, this is an investments topic, but not the stock market type of stuff. It's, do I expand the business with a new building, a new warehouse, new machinery, a new factory? Do I do a new product? Those type of investments where you have to put money up front and then with intent to produce something that is going to make profit and return on investment later. Capital structure. Now, I want you to remember this word because it's going to come around later in the course. But capital structure, it looks a lot like the balance sheet that you studied in accounting, but slightly different. Because what you're going to have is capital equals debt plus equity. While the balance sheet is assets equals liabilities plus equity, capital structure is very specific to debt on the liability side. So when we only talk about debt and equity, those two added together is your capital, your total capital. Now the capital structure would be how much debt versus how much equity you have. So let's say a company has $100,000 in total capital, and then $60,000 of that is in debt, and the other $40,000 is in equity. Then what you have is a 60% debt and a 40% equity as total capital. And that would be those two together is total capital, but that's 60% and 40%. That's your capital structure. And that's what it says here, how much we pay for our assets. Okay, that is your total capital. Should we use debt or equity or a combination? And that's what I mean. So you can have a combination of debt and equity in your company, and that split, whether 60-40, 50-50, 30-70, that's what the capital structure is. Working capital management, to refresh working capital, that is your current assets against your current liabilities. And you need to manage that, because if it gets out of hand, you can go bankrupt. You may have to shut down business if your working capital is not a healthy level where the current assets are able to cover the current liabilities. So how do we manage that? That will be it for this video. We will continue in a different video.